In civil engineering, when you construct a massive suspension bridge, you don't test its structural integrity by just waiting for a gentle breeze. You subject it to maximum load.
Right, you simulate hurricane force winds.
Exactly. You apply simultaneous heavy traffic, you park a dozen freight trucks dead center, and you use, acoustic sensors to find the exact microscopic point where the steel begins to groan. You actively look for the stress fracture.
Because it's only under that extreme, unyielding pressure that you discover whether the foundational architecture actually holds or if it, catastrophically fails.
Right. And right now, the global macroeconomic architecture is undergoing that exact structural stress test. In the last 24 hours, the financial system just got hit with those hurricane force winds.
Yeah, it's a complete recalibration of global liquidity.
And of decentralized digital assets, too. So today we are taking a clinical, direct look at the immediate data to decode what has fundamentally shifted in the macro environment for you, the listener. Welcome to the deep dive.
Thanks. And, the data from this exact 24-hour measurement window, it confirms that the pressure on the system has reached a critical threshold. We aren't looking at theoretical models anymore.
No, we're watching the stress test play out in real-time order books.
Exactly.
So let's start with the immediate, visceral reaction from the last 24 hours. We saw the spot price of the asset experience a violent plunge. It broke right through that heavily defended $69,000 threshold, hitting a localized trough of roughly $68,814.
Which is a massive level to lose.
Yeah, but this wasn't organic fundamental selling. This was driven by a massive algorithmic wipeout. I mean, nearly 400 million in derivatives were liquidated. Specifically, about 392 million in aggregate.
Right, and that microstructural failure was the direct algorithmic response to a massive geopolitical escalation overnight. Yeah. During the Nowruz holiday, the Israel Defense Forces executed direct airstrikes on Tehran's infrastructure. And the immediate financial fallout from that was the United States Pentagon submitting a $200 billion emergency supplemental funding request to the White House.
$200 billion.
Just to put that into perspective, that $200 billion is designed to finance merely the first 6 days of this specific operation.
Okay, let's unpack this. Because we need a clinical analysis of how kinetic geopolitical warfare mechanically alters a decentralized asset's order books. To understand the gravity of this, we really have to look at our baseline, like what we already knew heading into today, and compare it to the massive shift in today's intelligence.
Right, before and after.
Exactly. What we knew earlier in the week was that the conflict in the Middle East had previously disrupted maritime logistics. The Strait of Hormuz was effectively blockaded, which forced global shipping to reroute and created this steady, simmering baseline of energy inflation. We were already operating in a pressurized environment.
Right. That was the baseline supply chain pressure. But here is the massive shift in today's data. We have fully transitioned from proxy disruptions and shipping delays to direct sovereign military strikes.
Yeah, it's not just posturing anymore.
No. The IDF didn't just rattle sabers. They explicitly targeted and destroyed the Karaj surface-to-surface missile plant near Tehran. And the asymmetric response was immediate.
The drone strikes.
Exactly. Iranian drone strikes successfully penetrated Kuwait's airspace, directly striking the Mina al-Ahmadi oil refinery. The physical destruction of that refining capacity is what propelled Brent crude past $119 per barrel this morning.
Wow. Which brings us back to that critical piece of intelligence, the $200 billion Pentagon request. For you, the listener tracking global liquidity, I want you to think of that $200 billion not just as a defense budget line item. Think of it as an immediate, unbudgeted tax on the fiat supply itself.
It absolutely is.
But I want to push back on this a bit just to make sure we are parsing the mechanics correctly here. A $200 billion deficit is massive, yes. But why does this specific dynamic guarantee what quantitative analysts are calling fiscal dominance? Why does it mathematically require central banks to step in and debase the currency to monetize this debt rather than just issuing bonds normally?
Well, if we connect this to the bigger picture, you have to look at the inescapable macroeconomic trap the central banks are caught in right now. When you have crude oil surging past $119 a barrel, because physical refineries are literally burning in Kuwait, you have a massive supply-side inflationary shock.
Right. It costs more to transport goods, manufacture products, heat homes, everything goes up.
Exactly. And the Federal Reserve cannot lower interest rates to stimulate the economy without sending that inflation into hyperdrive.
Right, their hands are tied on rates.
But simultaneously, the U.S. Treasury has to issue $200 billion in new sovereign debt right now, today, to fund the military. With interest rates held at these elevated levels, the cost of servicing that new debt is astronomical.
And nobody wants to buy it.
Right. The traditional buyers of U.S. debt, foreign nations, pension funds, they aren't stepping up to absorb that much issuance at these yields when inflation's running at $119 oil.
Yeah.
So it crowds out private investment. Ultimately, the central bank is forced to artificially absorb that debt by expanding the balance sheet.
They literally have to print the liquidity to fund the war.
Precisely. In a stagflationary environment where inflation runs hotter than the yield on a treasury bond, meaning real yields turn negative, holding cash is a guaranteed loss. Therefore, exposure to mathematically scarce, non-sovereign assets transitions from being a speculative risk into a strict actuarial requirement for baseline capital preservation.
I mean, that makes perfect sense. And it perfectly sets up the microstructural fallout we just witnessed on the secondary market. If we pivot from the macro shock to the actual trading desks, we can see exactly how quantitative systems and institutional allocators reacted to this $200 billion deficit and the energy spike.
It was violent.
Very. Again, establishing our baseline, what we knew earlier in the week was that ETF inflows had already stalled out, and legacy whales, those 2013-era original adopters, they were taking localized profits. The order book was already softening.
Exactly. The liquidity was thin, which set the stage for a violent move.
But what is entirely new today is the absolute severity of the intraday mechanics. We saw that $392 million aggregate liquidation event, and the internal architecture of that wipeout is what tells the real story. Over $335 million of that total was forced long liquidations.
Yeah, it was a mechanical buy-to-cover failure.
Right. Tactical traders who assumed the $70,000 floor was permanent, who were trading on margin, got systematically squeezed out when the geopolitical news broke. And simultaneously, the U.S. spot ETF complex recorded over $90 million in daily outflows. BlackRock's IBIT alone lost nearly $38 million in a single trading session.
And we have to be clinical about the mechanics here. When those ETF shares are redeemed by investors panicking over a macro shock, the authorized participants who manage the ETF are mathematically required to dump the underlying physical collateral onto the spot market.
They have to sell the asset to pay the investors their cash.
Exactly. That severely exacerbates the downward price action, which is what physically drove the asset down to that $68,814 trough. But to truly understand the why behind this panic, we have to look at the newly finalized CF Benchmark's 13F filings. This is the forensic regulatory data that proves exactly who is driving this sell-off.
And it's not the long-term holders, it's the tactical hedge funds.
Precisely. The 13F data shows that Brevin Howard slashed its IBIT position by a staggering 85%. D.E. Shaw cut its position by over half. Farallon Capital cut its exposure by 70%. These traditional macroeconomic funds are actively trading the geopolitical panic.
Here's where it gets really interesting, because we are witnessing a massive structural divergence in market psychology. On one hand, you have these tactical hedge funds dumping paper ETF shares at the very first sign of a macro panic to de-risk their quarterly portfolios. But contrast that behavior with entities like American Bitcoin Core or ABTC.
Right, the corporate buyers.
Yeah. While the hedge funds were panic-selling paper, ABTC just formally expanded its physical corporate treasury to 6,899 BTC. They are hoarding the actual cryptographic collateral while the funds sell the wrappers.
It highlights fundamentally different time horizons and structural models. The hedge funds are treating the ETF wrapper as a high beta tech proxy. When oil spikes and war breaks out, their quantitative risk models auto-trigger a sell-off across all risk assets. They don't care about the underlying asset's scarcity. They care about reducing portfolio volatility today.
It's just a ticker symbol on a screen to them.
Exactly. But corporate treasuries like ABTC are operating on a completely different paradigm. They are treating the underlying asset as a zero-duration vault.
A zero-duration vault, right.
For those mapping the financial plumbing, a zero-duration asset means it carries no expiration date, no counterparty risk, and its value isn't dependent on an interest rate yield curve. By pulling the asset into their corporate treasury, they're actively removing physical collateral from floating circulation. They're essentially treating it as a permanent hedge against that exact fiat debasement we just detailed with the Pentagon's $200 billion request.
So while the hedge funds are playing short-term tactical games, dumping paper wrappers at the first sign of trouble, the legacy banking monopolists are quietly operating in the background, executing permanent infrastructure upgrades to capture the underlying asset.
Oh, absolutely.
Which brings us to the traditional finance infrastructure. What we knew coming into today was that the SEC had previously mandated a highly inefficient cash-only creation and redemption model for all spot ETFs. It was a major friction point for institutions.
It was incredibly inefficient. A cash-only model forced authorized participants to liquidate the asset into fiat currency across fragmented secondary exchanges just to process a redemption. That generates massive tax burdens, incurs exchange fees, and creates execution slippage where the price moves against you while you were trying to sell.
Right. But what is breaking today changes that plumbing entirely. Morgan Stanley just submitted an amended S-1 registration statement and S-1A for their proprietary Morgan Stanley Bitcoin Trust, the MSBT.
The MSBT, yeah.
The trust secured $1 million in seed funding, specifically 50,000 shares priced at $20 a unit. But the seed funding isn't the headline. The critical data point is that Morgan Stanley is explicitly demanding a dual-track framework that allows for in-kind physical subscriptions and redemptions. So, asking this on behalf of the listener who might not spend their days reading SEC filings, why does transitioning from cash settlement to an in-kind mechanism fundamentally alter the plumbing of Wall Street's relationship with this asset?
What's fascinating here is that an in-kind mechanism entirely eliminates the friction that kept massive sovereign wealth and pension capital on the sidelines. In-kind redemption means an authorized participant doesn't have to sell anything on the open market.
They just swap it.
Exactly. They can directly swap the actual physical cryptographic collateral for the ETF share and vice versa. It systematically eliminates the tax friction because there is no taxable sale of the asset. It completely removes the execution risk, and it prevents the slippage of routing massive block trades through secondary exchanges.
They bypass the public exchanges entirely. They don't have to touch the open market.
Exactly. They operate on their own institutional rails.
Right.
And to facilitate this, Morgan Stanley isn't just relying on small crypto-native firms. They're bringing in Macquarie Capital and traditional banking behemoths like BNY Mellon to operate as the designated manager, cash custodian, and transfer agent.
Wow.
This is Wall Street successfully domesticating the network. By demanding in-kind mechanisms and integrating with BNY Mellon, who holds trillions in legacy assets, they are stripping away all the complexities of private key management and self-custody. They are creating a direct, frictionless pipeline to channel sovereign institutional capital right into the asset, using the exact same infrastructure they use for traditional equities.
It's the ultimate regulatory and structural capture. The old guard is moving in and laying down their own pipes. But while legacy finance perfects the paper wrappers and the institutional custody layers, the actual physical infrastructure generating the asset and the legacy crypto-native corporations are buckling under extreme industrial pressure.
The stress test is definitely hitting them hard.
Let's look at hash rate economics and corporate governance. What we knew heading into this quarter was that the mining sector was already facing immense difficulty from the halving, the automatic reduction in block subsidies, and fierce supply chain competition for silicon from the artificial intelligence industry.
Yeah, the profit margins for miners were already compressing significantly before any of this geopolitical macro shock hit.
But today's new data paints a brutal clinical picture of exactly how severe that compression is. We just received the unaudited 2025 financials from Bitfufu, which is a Tier 1 highly capitalized institutional miner. Despite generating $475.8 million in aggregate revenue, they printed a devastating $57.4 million net loss.
That's a massive hit.
And here is the clinical metric you need to pay attention to. The baseline cost for them to manufacture a single unit of the asset skyrocketed to $77,573. Meanwhile, the network difficulty is expected to drop to $134 trillion as undercapitalized rigs are physically unplugged from the wall.
And that $77,573 production cost is a mathematically fatal metric for pure-play miners because it sits substantially higher than today's spot price of $68,814. It guarantees negative operating margins for inefficient hardware fleets. Every time an older machine solves a block, the company loses money in electricity and operational costs.
And it's not just the physical industrial infrastructure failing, it's the corporate governance of legacy crypto firms themselves. Simultaneously today, we are tracking a massive class action lawsuit filed in the Southern District of New York against Gemini Space Station. Their public stock collapsed over 80%, falling from a $32 IPO down to roughly $6.01. This spectacular crash happened after they executed a completely undisclosed pivot dubbed Gemini 2.0, moving away from their core exchange operations into decentralized prediction markets, which was immediately accompanied by brutal 25% layoffs.
The clinical analysis of these dual failures is stark. On the corporate side, the Gemini lawsuit proves that traditional equity markets have absolutely zero tolerance for governance failures or strategic bait and switches in crypto proxies. The market will mercilessly punish opacity and mismanagement.
Right, Wall Street won't put up with it.
No, they won't.
Yeah.
And on the hardware side, that $77,000 production cost forces a massive industrial consolidation. The era of the independent pure-play miner is effectively ending. Only heavily capitalized enterprise artificial intelligence data centers, entities that can offset their mining losses with high-margin AI compute contracts, can afford to secure the cryptographic ledger moving forward. They have the energy contracts and the capital to weather the storm.
So what does this all mean? I have to challenge this narrative a bit because I'm looking at these numbers and it seems like a glaring contradiction. If it costs almost $78,000 to mine an asset that's trading at $68,000, causing a $57 million loss for a top-tier operator, and massive legacy companies like Gemini are imploding post-IPO under the weight of governance fraud lawsuits, doesn't that highlight a fatal vulnerability in the decentralized architecture itself? Doesn't the bridge buckle under this specific stress test?
It certainly looks like buckling from the outside, but it's actually a required mechanical purging process. Think of it like a controlled forest fire that burns away the dead brush so the strongest trees can survive.
Yeah.
The underlying network is a closed mathematical system designed to aggressively purge inefficiency. The protocol doesn't care if a corporate entity like Gemini faces a lawsuit, and it doesn't care if a Tier 1 miner goes bankrupt. When those inefficient operators shut off their unprofitable machines, the protocol simply adjusts its own difficulty downward, which is exactly what we are seeing with the expected drop to 134 trillion.
It naturally recalibrates.
Exactly. It makes it easier for the surviving, highly efficient operators to mine. This industrial friction is actively purging the undercapitalized actors to build an oligopoly of heavily fortified infrastructure providers capable of surviving an era of fiscal dominance.
That makes a lot of sense. Let's synthesize this clinical data for the listener to close this out. Today's roughly $400 million derivative flush and the subsequent geopolitical panic selling are short-term microstructural noise. It's the sound of tactical hedge funds reacting to immediate headlines.
Your noise.
Right. The undeniable permanent signal for you to track is the unbudgeted $200 billion defense requirement, which absolutely guarantees further fiat debasement, coupled with Morgan Stanley's permanent in-kind structural integration of the asset into the legacy banking rails.
Exactly. For you, the listener, navigating this landscape requires zooming out from the intraday volatility of a $68,000 price point. In an environment of engineered stagflation, where oil sits at $119 a barrel and global energy logistics are physically collapsing, continuous exposure to mathematically scarce assets is no longer a speculative bet.
It's a necessity.
It has transitioned into a baseline actuarial mandate for capital preservation. The legacy fiat system, burdened by impossible debt and high rates, is failing the structural stress test.
The structural load of that debt is simply too high.
This raises an important question for you to consider. If Morgan Stanley and BNY Mellon successfully perfect the in-kind institutional capture of the asset, domesticating it into Wall Street's plumbing, while at the same time, extreme production costs force independent miners to capitulate, handing control of the network over to massive corporate AI data centers, does the decentralized revolution ultimately just become the ultimate immutable back-end database for the legacy financial system?
Wow. We started by talking about the stress test of a massive suspension bridge. The macro wind is howling, the geopolitical load is maximizing, and the legacy iron of fiat currency is cracking under the weight of $200 billion in unbudgeted debt. But it seems the cryptographic steel underneath the new architecture is holding. It's just being quietly acquired by the very financial engineers who built the old bridge.